I've got a lot of nods. That's good. Okay, recording in progress. Good to see. Um, so tonight, my name is Tony Formica. I'm presenting on the finance sections of the board readiness course. So tonight is foundations, or what we've termed foundations of finance. And it's just basically to introduce people to what a set of financial statements looks like at a fairly simple level. So we're going to have 15 minutes of welcome and introductions. I think I'll actually hold off on getting everyone to introduce themselves until Thursday night. I think that makes more sense when we're all in the one room. But I will give you a bit of a background on myself. So I'm a chartered accountant by profession. Also got an MBA from UQ, fellow of the Institute of Company Directors. I've also presented the finance sections of the Company Directors course for the Institute of Company Directors in the past. So done a bit of things in this space. So I've had 10 years in chartered accounting firms, another 14 years working for a relatively large private company. It says there 6 years as CFO, 8 years as CEO, but we didn't replace me as CFO when I took over as CEO, so I really had both there for 14 years. Since then, I've spent the last 12 years working in the startup sector with clean tech companies, specifically around a type of recycling shower that we were developing, a type of wind directional skylight ventilator that we sell on the market. And I've also had 7 years on the board of the Leukemia Foundation, so I've got a bit of experience as a director of not-for-profits too. So the aim of tonight is to give participants an understanding on the structure and purpose of the financial accounts. I'll use this generic terms, which is profit and loss, balance sheet, and cash flow statement. In the actual annual accounts, they like to refer to them as a statement of comprehensive income, which is a P&L, and a statement of financial position, which is a balance sheet. The terms are really interchangeable. So before we actually start looking at some of these things, I want to talk about a few different concepts that affect the way that a set of accounts are put together. So the first one is a reporting entity concept. So it's the reporting entity concept is how we define the organization that we are preparing a set of accounts for. And it's defined around whether there are users that need financial information that don't have the ability to access that financial information other than from a general set of accounts. Now, that may be a single company. It may be a group of companies where they're consolidated. It might be a partnership or a trust. So the term entity can actually cover all of those different types of organizations. So the difference between them will be the way it is governed. So with a company, it'll be governed under either the corporations law, if it's a for-profit company, or if it's a charity, it might be governed under the Australian Charities and Not-for-Profits Commission. So we'll talk a little bit more about that one on Thursday. So once we've worked out what the entity is that we're preparing a set of accounts for, we then need to look at some of the other concepts that might affect how we go about preparing those accounts. And the first one is the concept of going concern. So when you're preparing a set of accounts, one of the first decisions that you will want to make is this business or organization a going concern? Can it continue to pay its bills going forward, or is it in financial trouble? Is it something that was set up for a limited life? So an organization, for example, one of the ones coming up might be the new organization for the Brisbane Olympics. It might finish at the end of 2032. So in those type of situations, the business will not be something that will continue indefinitely into the future. Now, that will change the way we come up with some of the numbers for the organization. For example, with an asset, you've got to make sure that the value of the asset to the business is at least what you're showing in the accounts. Now, that value can either be what you can sell that asset for externally, or what they term value in use. So the value that the business gets it from using that asset, whether it's property that they run the business out of, or if it's a manufacturing company, a piece of machinery or something. So if you've got organisation, say it's a mine that has a useful life of 5 years, all of those assets will need to be effectively written down to what their realisable value is at the end of that 5 years. If there is no time frame to it, those assets will be depreciated as any other asset would be depreciated based on its useful life. The other thing with going concern is if you have the threat where the business is going to potentially have to go into bankruptcy and it can't pay its debts, then the values ascribed to the assets will quite often be lower, because you might have to the liquidator or administrator who's appointed might have to dispose of those assets in effectively a fire sale to get money to pay the creditors, employees, shareholders, and so forth. And if you're preparing a set of accounts and you believe that the business is in that situation and you've appointed a liquidator, that set of accounts will be prepared with very different numbers to what it would be if that business was just running on as per normal. The next thing to consider is the accounting policies. Every set of accounts has to be prepared in accordance with the accounting standards. There is a lot of them. I'm not going to try and teach any of them to you either today or Thursday. As a director, you need to be aware of the accounting standards, and you need to get the advice that you need to make sure your organisation is complying with them, whether that's from employees within the organisation, an external accounting firm, external auditors even are a great source of help with that. Now, within those accounting policies, there are many different ways that you can treat things. For example, with inventories, inventory is valued at the lower of cost or net realisable value. So if you can't sell it for more than the cost, you've got to record it at what you can sell it for. The problem is when you look at cost, there are many acceptable ways to cost your inventory. If you're a manufacturing company, you might use standard costing, in which case you come up with what the usual cost of making that item is, and you will have variances in your production when the production is working very efficiently, not very efficiently, when you have machine breakdowns. All those things will change the actual cost, but what goes into the value of inventory in the actual accounting system will be what you've determined that standard cost to be. It might be with inventory, you might value it on an average cost basis. So all of the stock that you buy in gets accumulated. You take the total cost of what you've bought divided by the total number of items that you've bought, and that then becomes the cost for that item. Or it might be a first in, first out basis, in which case the oldest one is the cost that gets sold first. So the important thing with the accounting policies is you need to disclose which ones you're using. Now, in the past, that's all been done in note 1 and then repeated in the individual notes that talk about fixed assets or inventory or wherever that particular thing is. They are trying to change it at the moment because from a user perspective, note 1 used to scare a lot of people. So now they're basically saying that the only time you need to put it in the first note is if you've had a significant change from the previous year, or if you haven't told people what you're doing later on in a specific note on that issue. All of the accounting standards in Australia are adopted from the international accounting standards, except for not-for-profits. So with the accounting standards, anything below the number of 1,000 is compatible with the international standard. Anything over 1,000 is something that we have in place specifically in Australia for not-for-profits. And there will be some situations with a not-for-profit board where you'll have to choose which of the two standards you're going to comply with. One example I had recently was on revenue recognition for government grants. So under AASB 15, which is the international standard, you have to recognise the income as soon as you receive the grant. But under AASB 1058, which is the Australian not-for-profits one, if you can specifically identify the grant monies to the achievement of certain things that you must do under that grant, you can actually carry forward some of that income to future years and offset it against those expenses. So, and the arguments around this can get quite technical. And as a director, the most important thing that you need to do is be aware of the fact that there are some of these issues going on, and to take an active interest in what your accountants and your auditors are talking about. And if they seem to be having a fight about something, you need to try and get them back where they can find a middle ground. Not that accountants ever fight. The next concept to talk about is the timing of income and expenses. So an example was what I just talked about with the grant income. You can, under some of the standards, you might have to recognise it straight away, even though the project that's being funded might run for 2 years. That, as an accountant, to me, doesn't make a lot of sense, but that's what's in the international standards. With the other types of things that might be affected by accrual accounting, for example, rent on a premises. So if you're renting a building and you're paying your rent 3 months in advance, you won't want to take up all of the rent in June. You might want to take up a third in June, a third in July, and a third in August. So that's what we refer to as accrual accounting. If you took it all up in June, that would be what we would call a cash basis for the accounting. So it doesn't, most businesses will use accrual accounting. There are situations where cash accounting is quite appropriate. The key thing is to be aware of what method your business is using and just make sure that they're consistent within the way that they do that. And the last concept I want to talk about is materiality. I will almost guarantee you that there is no set of financial statements in this country that is 100% accurate. There will always be something that is missed somewhere, whether it's an invoice that comes in after the end of the year that no one notices and doesn't pick it up and accrue it. The key thing here is it material? So particularly when the auditors are going through looking at a set of accounts, they will do a lot of testing, particularly around transactions that happen around about your year end. So they'll look at a lot of the things that come in after the end of the year, a lot of the things that were paid just before the end of the year, and they'll make sure that they're in the right period. Now, generally speaking, when the auditors do that, they will come up with what they term a management letter, which they'll present to the audit committee or the board. And in that management letter, they'll list out all the things they found that they think they're in the wrong spot. In 99% of the cases, they'll say, we've found these things, they're in the wrong spot, but they're not material. So we're not suggesting you change anything. Okay. The definition of materiality in the accounting standards is not very specific. What it says is if a failure to correct the error would cause a user of the financial statements to change the way they allocate their resources, then it's material. So basically, if you don't make the change and someone decides to invest in the company, thinking that the accounts said one thing, when in actual fact, if the change had been made, they would have changed their decision and not invested in the company, then it's material. So auditors in particular have a lot of formulas that they run through to determine what they think materiality is for individual companies, and it is different. When I started out in audit back in the 80s, generally speaking, it was about 5% effect on profit, but they're a lot more technical on the way they determine those percentages these days. And yeah, listening to the auditors and working with them on that sort of thing is important. And at the end of the day, if something's wrong, it should be changed. So that's on the main things on the concepts. Just to talk about the way these accounts are prepared. Actually, before I go on, has there anyone got any questions on any of that before I just start rattling through everything? And
yes, I do.
Go for it. Sorry,
All right,
Ray.
you have to go back to the slide. So I have
Sure.
my first question in regards to the timing of incorrect expenses.
Income and expenses.
Income and expenses. So when you say accrual accounting, understand that the rent you used as an example,
that's
3 monthly, so you would take it out a third, a third, a third.
Yep.
In my experience, I've come across talking to the accounts people when a telecommunications bill hasn't actually been received by the client, but they've said that they've accrued the amount. Can you talk about that, please?
Okay, so with the accrual accounting, there's actually two concepts. The first one is accruals, which is where you take up an expense that you have incurred, but not yet received the invoice for or paid. So if you've incurred the expense and received the invoice, usually the invoice would have been processed into the accounting system, and that value will be sitting in your trade creditors waiting to be paid. Okay. If you haven't received the invoice, but you know that you're going to receive the invoice, you make an allowance for what you think that expense is going to be, and you put the expense through. So talking about what a journal entry would be, that would be debit the expense account and credit accrued expenses. So you don't have a creditor's ledger like you would with all the invoices waiting to be paid, but you will have a separate spreadsheet usually that keeps a total of all of the expenses that you are expecting to come in. Now, when the invoice comes in, you would take the invoice up into your creditors, but instead of the other side of that going to the expense account, it will offset what's in the accrual account. So it'll decrease the accrual and effectively move it from accruals to creditors. Okay. And then at various stages, you'll need to have a look at that accrual account and see, okay, there's these 5 things that have been in there for 3 months that we've never been invoiced for. What's happened to them? Are we going to get invoiced or not? And the good companies will chase up the suppliers and get a copy of the invoice and deal with it. The ones that aren't quite so diligent might hope they never get an invoice and hope it goes away. So the other side of it is the prepayments, which is what I was talking about with the rent before. So because you usually pay the rent in advance, but you don't want to take up the entire expense in June. You want to spread it out over the period of that you're occupying the property for. So, and that can apply to any sort of an expense. I mean, it might be interest, for example. A lot of people, as a tax planning opportunity towards the end of the year, might actually make a large prepayment of interest. And they can actually claim a tax deduction for that if it's been physically paid before the 30th of June and it's not more than 12 months worth of interest. So there is a cap on it. You can't just pay 5 years out or anything. But there's those sorts of things, in which case you would actually take up 1 month's worth of interest in your accounts and put the other 11 months worth of interest sitting in a prepaid expense account. And the actual tax return would be different because the tax return would claim a deduction for all 12 months. So your taxable income will be different from your profit by that 11 months that's sitting in prepayments, which is specifically allowed as a deduction.
Thank you.
Can I ask a
Well,
quick question? What is the difference between that and amortization? Is it normally like a license or something that you do amortization for, like
okay.
specifically?
Amortization and depreciation are very similar concepts. Depreciation is what you do with a physical asset. So if you've got a car or a piece of machinery, you'll depreciate that over its useful life. Amortization is exactly the same thing, but it's for a non-physical asset. So for example, with your lease accounting, if you're committed to a 5-year lease, you actually have to take up the liability for all of the payments of that lease in your liabilities. You then take up a separate asset called a right of use asset for using the premises that you're renting or the machinery that you're renting, etc. And as that lease progresses, you pay out the liability, but you amortize the value of the asset. There is a few adjustments you have to do to that because the amortization will not match the lease payment exactly because there'll be an interest component in there. So effectively, as you're paying the lease payment, instead of having it appear as a lease expense in the P&L, it'll appear as effectively the amortization of the right of use asset and interest. So, but the two should add up to the same amount.
Okay,
So,
thank you. I probably
and
have more questions in that space later.
that's okay.
I think
But
in technology, I'm seeing a lot of that for software as a service kind of contracts. So
absolutely, and
yeah.
it happens across all intangible assets. So leases is one of them, but intellectual property is another. So if you've got intellectual property that's capitalized on your balance sheet, whether it's a trademark or a patent or something like that, you'll generally incur all of the costs for that upfront, and then you'll amortize that over the useful life of the patent or the trademark or whatever it might be. Same thing happens with research and development expenses. So you have to make a choice at the start as to whether you're going to capitalize that research and development expenditure or expense it directly to the P&L. Now, there'll be a whole lot of things you need to consider in working out what is the right approach for that. But if you do decide to capitalize it, then again, that needs to be either amortized or at the very least assessed for impairment each year. Assessing for impairment is something I'll probably talk about a bit more on Thursday. Any more?
I had a question.
Sure, Melissa, fire away.
So you were talking about the international standards versus domestic, and you said anything below 1,000, anything above 1,000. When you're talking about 1,000, are you talking 1,000 revenue?
That's the number of the standard. So every standard has a number. So you've got AASB 15, which is the revenue recognition standard, or AASB 1058, which is the not-for-profits revenue standard. So yeah,
got it.
I couldn't tell you all of the standard numbers. I've long since lost the ability to keep all of those in my head. But yeah, they're all available for people to read at their leisure.
I don't know why you don't know them all when there's thousands of them.
I know, particularly when I don't generally prepare sets of accounts on a regular basis, because most of my businesses are too small to require general purpose financial statements. The bank or anyone who wants specific information, they just ask and we give it to them. So,
thank you.
Any more questions before I move on? By the way, there is no such thing as a stupid question. The only person who can say something stupid in this meeting is me in an answer. So I'll try to avoid that. Cool. So within a business, most businesses these days will have some sort of computerized accounting system. Now, the breadth of how that intertwines with the organization will vary depending on the software that they use and how well integrated it is into all of the procedures. So at the top end of the scale, you'll have what they call enterprise resource planning systems, which will do production planning, it'll generate your sales invoices, it'll take care of all of the stock entries, it'll give you visibility for the likely sales that you'll have coming up into the future. It is incredibly highly integrated into every aspect of the business and can provide an incredible amount of information to help the business get better. Then you can come down to the other end of the scale with the much smaller businesses, your local sports clubs, the business I'm involved with the ventilator and skylight. We do the accounts for that in a package called Xero. So, you've probably heard of Xero and MYOB and those type of packages. They're generally for the smaller end of the market, and the tentacles of that software doesn't reach as far into the businesses with an ERP system. So the key thing is that computer system has to be the single source of truth for your business. So whether you're preparing a set of management accounts or a set of annual financial statements, they all need to come from the information that's in that system. So you need to make sure that the information that's going into that system is correct. Because if it's not, your management accounts and your annual financial statements will not be correct. Because, it's the usual computing statement, garbage in equals garbage out. So one of the things that auditors will check for is what they call systems and internal controls testing. So they will select a sample of transactions from all throughout the year, not just around year end, to make sure that they're being processed correctly and that there are appropriate internal controls around the way that they are processed. So, for example, that might be having 2 people sign off on all expenses. That's an internal control. In the old days, it'd be 2 people signing the checks. So each check needed to have 2 signatures on it. But these days, it mostly happens electronically. People log in and use their, either a little key ID number that rotates and so forth. So there's always a data trail there of who has authorized those payments. It might be controls around your debtors system. For example, one instance we had in a business I was involved with where the lady in charge of debtors was actually committing fraud against the company. And the way she was doing it is the customers were paying their bill, but when they paid in cash, she'd pocket the cash and put through a credit note to get rid of the bill. And, $1,000 worth of credit notes against $30 million worth of sales, you don't notice. But eventually that one got picked up, and it's not good when that sort of thing happens, but it's important to make sure that there's a control in place that the person who's receiving the cash doesn't also have the ability to do the credit note. So after that, we actually changed the procedure where all the cash was collected effectively at reception and the banking prepared there and taken to the bank, and then the accounts receivable team picked it up from there. So it's just a matter of separating the access to those things, and that's what they call an internal control. It might be a physical control too. So, making sure all of your plant and equipment's locked up in the yard and you've got security cameras. That's a internal control. Making sure all of your computers have ID tags on them so you can identify at the end of the year that you still have them all. Those sorts of things. The difference between management accounts and annual accounts are management accounts are what is used to run the business. So if you're on board, your monthly board packs should include a set of management accounts. Now, what they will show you is a fairly simple structure of a profit and loss, balance sheet, sometimes cash flow, sometimes not. You should at least have some sort of cash forecasting in there, because one of the things you need to be aware of as directors is the company going to be able to pay its debts? And if you don't have a cash forecast, that's a little bit hard to tell. The other type of financial statement is your annual reports. So that's what you'll often see that go for 50 odd pages. have all of the notes to the accounts, and they're audited. They have the audit reports on them. Management accounts typically are not audited. Some of the bigger companies will have an internal audit department, which will do the same job as what an external audit firm will. They'll have a higher focus on the internal controls and the systems processing and that sort of thing, though. The annual reports will usually be lodged either with ASIC or the ACNC. So that's the Australian Charities and Not-for-Profits Commission. It depends on if you are registered with ACNC or not. If you are registered with the ACNC, there's a whole section there that excludes certain sections of the Corporations Act. So someone who's registered with the ACNC doesn't have to comply with a whole lot of sections of the Corporations Act. Instead, they have to comply with equivalent sections in the Australian Charities and Not-for-Profits Commission Act. So in a lot of cases, there's not much difference, but there can be some minor differences. And if you're talking about what the accounts are prepared against, you've got to quote the right one. So generally speaking, the difference between the two is that with ASIC, you're likely to have a lot more external users that might be making investment decisions relying on it. So they generally have a lot more disclosure requirements. So a lot more things that you have to tell the users of the financial statements. Generally speaking, I'll go back a step. Within your accounting standards, there are two types of standards. One is a measurement standard and one is a disclosure standard. So the first one tells you how you have to measure something. So how you have to value your inventory, how you have to value your plant and equipment, that sort of thing. The second one is what other things you need to tell people about. So it might be a disclosure of a contingent liability, for example. Now, a contingent liability is something where you may owe money to someone else, but you just don't know yet. It depends on what might happen. The typical example there might be a court case. So you might have had an employee that's brought an unfair dismissal claim against the business, and at the end of the year, it hasn't even gone to the Fair Work. So you just don't know what's going to happen there. In that case, you don't actually put anything into your financial statements in the balance sheet and profit and loss for that particular claim. What you do instead is you disclose it in the notes to the accounts and say, we have this claim that's been made for unfair dismissal. We don't know what's going to happen with it. If we do lose the claim, the potential financial impact of this might be between X and Y, that sort of a thing. So that users of the accounts are aware that there is something out there. It doesn't have to be unfair dismissal. It might be like with BHP, where they had that failure of that tailings mine in South America and caused a lot of contamination downstream of the local businesses. So that was a contingent liability at the time, but would turn into an actual liability. So that's really the difference between management accounts and the annual reports. Are there any questions on that?
Yeah, Tony, it's Glenda here. I just wanted to ask around the auditing of reports.
Yep.
And just to clarify, my understanding of auditing of the reports is to audit the financials according to how they're submitted to make sure they adhere to the rules, regulations, and guidelines. But they're not necessarily audited to demonstrate good practice, bad practice, good performing company, bad performing company. Is my interpretation correct?
Sort of. My last slide of the day is talking about audit reports. So we might cover it then.
Leave it. Yeah, no worries. Thanks.
So any more questions before I merrily charge on? Cool. Okay, so leaving aside management accounts, which will be different for every company. So every company decides the information that they need to run their business effectively and efficiently. So, they might have a much higher emphasis on providing data graphically. They might decide that they have a very high emphasis on providing ratio analysis of, how gross margin is behaving, or gross profit, or, what the average day's collection of debtors are. Those sort of metrics might be more important to them than the type of stuff that you would see in an annual report. So generally speaking, the board and management together would work out the types of information they want to see. There is a balancing act that you need to do. I've been on boards where we have received very little information. You might get a monthly board pack that has about 12 pages. And generally speaking, that's not going to tell you everything you need to know. I've also been on a board where we've received board packs of 450 pages. Now, on a monthly basis, no one is going to be able to read through 450 pages. Whenever I get something like that, I start to question, what are management trying to hide within the middle of this? And later on say, we told you about it, it was on page 306. And it effectively gets hidden by the sheer volume of information. So the trick when working out what to put in those reports is to work out what's important and have management only give you what's important. If individual directors want to drill a little bit deeper in areas that are their particular area of expertise, they can ask for a separate briefing on those particular areas. But that's how you generally have to deal with that. What I'm going to talk about for the rest of today is the annual accounts, which every organisation has to do. These are the ones that have to comply with the accounting standards and the requirements of the Corporations Law and the ACNC Act and that sort of thing. So a company's annual report will typically include the following things. There'll be the statement of comprehensive income, which most people would refer to as a profit and loss. A statement of financial position, which most people would call a balance sheet. Statement of cash flows, which everyone actually calls a statement of cash flows, which is nice. Then the notes to the accounts, which have all of the additional disclosures that aren't necessarily in the actual accounts above, but provide more information about those areas. And they also tell you the types of judgments and estimations that you've made in coming up with the numbers that are in those accounts above. Then there's the director's report and declaration. Now, I'll talk about these a little bit later as well. And at the end, there's the auditor's independence declaration and report. So I'm just going to run through slides on each of these now. So the statement of comprehensive income, or profit and loss, shows the revenue earned by the company less the expenses incurred by the company over a period of time. Now, in a set of management accounts, that might be monthly. So you might have profit and loss for April. Generally speaking, if you have that, you will have a second set of columns, which will be year to date. So you will see the profit for the month of April, but you'll also see the profit for the year to date at the end of April, which will be 10 months worth of trading. In your annual return, that is almost always 12 months worth of data. So it's usually from the 1st of July to the 30th of June, unless you have a substituted accounting period. They're not that common. Generally speaking, you only get a substituted accounting period if you are a subsidiary of an overseas company that has a different year end. So, for example, I worked on a few UK companies that had 31 December year ends. So the companies in Australia actually applied for a substituted accounting period, and they prepare and lodge their accounts as at the 31st of December instead of 30th of June. They also get approval from the tax office to lodge their tax returns for the year ended 31st of December, just so that they can keep everything in line. So this is what a typical profit and loss statement would look like. Can everyone see all of that? Good, because I have a little bar at the top of my screen that's covering up the years. So this is what you would generally see in a set of management accounts, I suppose. It's a relatively clear and straightforward looking profit and loss. So you've got your income, less your cost of sales coming to a gross profit figure. And then you've got all your expenses, which comes down to a net profit or a net loss. Now, within the annual financial statements, you don't need to provide that much detail. And in fact, most businesses will not provide this much detail, mostly because their competitors could go online and have a look at it. And they don't want their competitors going through and analysing this level of detail to try and work out where they could get an advantage over you. So generally speaking, it's a much shorter statement. They might have 3 or 4 categories of expenses. So they might have logistics, sales and marketing, finance and administration. And they might not have any breakup of what makes up those particular expenses within those categories. But generally speaking, you'll be able to track from year to year whether their finance and admin costs are going up or down. So from a management perspective, that's not particularly useful, which is why your management accounts will go into a lot more detail on that sort of a thing. Now, as a director, you'll be provided with these. You won't have to prepare them. What you need to do is to apply your mind and knowledge of the business to it and work out if they make sense to you or not. The key thing is to ask questions. Ask a lot of questions. It's how you learn about the business, and it's how management can teach you more about the business. And if you learn more about the business, you'll be a better director. So in reviewing a profit and loss, the sorts of things that you would want to look for are, for example, is all of the revenue included? Did you send out a whole lot of goods in the last week of the month, but the invoice run hasn't been done yet? That sort of a thing. Is there some grant income which should have been taken up that hasn't been? Those sorts of questions. So that's always a good generic question to ask. If you know a bit more about the business and know of a specific income stream that they might miss data on, you can specifically ask about that. You can ask about what type of accrual accounting policies have been used. Are they matching the income with the expenses? If they're not, why haven't they done it that way? So, for example, when I talk about matching income with expenses, if you're selling goods, for example, you don't want to take up the revenue for selling the goods in one year and then have the cost of sales in the following year. You want to have them both in the same period so that when you're looking at the profit margin you're making on the sale of those goods, that you're actually looking at correct data. Same could happen with the services business, by the way. If you're billing the customer up front and providing a professional service over the next 3 months, you might want to be spreading that income over the period that you provide the service. So make sure that all expenses are included. And I've got after that, for example, that is not capitalized. So for example, research and development is a good one. If you're putting a lot of money into developing a new product, you might have the ability and desire to capitalize that expenditure. There are a whole lot of rules around what can and cannot be capitalized. Generally speaking, basic research can't be capitalized. So if you're conducting a whole lot of biotech research, hoping to make a discovery that will then lead to something, generally speaking, that needs to be advanced. If you're a little bit down the track and you've identified something where this particular protein might be having an impact on something, and you're now at the stage of trying to work out how you're going to come up with a treatment to solve a particular problem, and you're actually in the process of developing a treatment, whether that's a drug or a physical treatment or whatever it might be, that development cost may be able to be capitalized. Now, the reason you would want to do that, take the COVID vaccines as an example. A lot of the companies developing those have put an enormous amount of money into developing those very quickly. But then that income from selling those vaccines wouldn't all come in the year that they spent the money developing them. It would have come over the next 3, 4, 5 years. So why you would want to capitalize that development cost is so that you can spread it over the 4 or 5 years where they're actually selling the vaccines. And it just matches the expense of the development of the product with the sales that you're getting for the product. So they're the sorts of things that you would want to look for. You might have a similar sort of thing within your buildings, for example. If you replace the carpet in your building, that's going to be a maintenance expense. So you're going to put that through to the P&L. But if you rip the carpets out of the building and put a soundproofed, shock-resistant floor in, that's actually an improvement to the building because you're not replacing like with like. So that would be a capital expenditure where you would take it up as a separate asset and depreciate it over the life of that new flooring. So they're the sorts of things that you would want to consider as to whether something should be expended or capitalized. As a director, you might know of some of those things that are happening. And then you might be able to ask the question. So you might know that a particular building is being renovated. And when you get the accounts, it might not be obvious as to whether people have considered what should be expensed and capitalized. Just ask the question. Have we considered this? If we have, what are the things that we've decided to capitalize, or is it purely, repairs and maintenance? Are there any write-downs required to things like debtors or inventory or other assets? Because that will affect the profit and loss. So, for example, if you've got $600,000 worth of trade debtors, but 5 of the customers that are in there have gone bankrupt and you're never going to get that money, those debtors should effectively be written off. And when they're written off, you'll have a bad debts expense that will appear in the profit and loss. So, the old saying, a sale is only a sale once you've been paid for it. If you don't get paid for it, it's not a sale. So the writing off of that debt effectively removes the sale. Unfortunately, you still have to wear the cost of the goods that went to the customer. So similar sort of thing with inventory. One of the things that auditors and management should do at the end of each year is do a assessment of the inventory for anything that is obsolete or slow moving. So if, for example, you're a car manufacturer and you've discontinued one of your models of cars, and that particular model of car was the only one that used a particular gearbox, any stock of that gearbox that you still have that you're not going to be able to sell as replacement parts in the future will need to be written off. That sort of thing. The slow moving part of it would be, for example, if you've got a particular item where you might have 100,000 units in stock, but you're only selling 15 of them a year. So having the total value of those 100,000 units sitting in your inventory is probably misleading, because you're not going to be able to convert that into $100,000 worth of cash if people aren't going to buy them. So that's what that's about. The similar sort of thing with other assets. You would effectively look at all of your other assets and see if there's any other ones that might need to be written down. So it might be plant and equipment, for example. Something might have a useful life of 10 years, but if it's used in a process that you're not going to be using anymore, you've got to write it off now, because you're not going to get any value out of using that plant and equipment in the future.
Just quickly, in terms of sorry, I keep asking these questions in relation to IT stuff, but I think I have seen where there's a project that implemented software that like was never really that great, and they kind of went, oh, we're 3 years in and we think that we need to replace it, that's something they would, in writing it down, they just kind of finish off all the depreciation and go, thanks,
So
see you later, let's try again.
What they would have done at the start is they would have made a decision to capitalise the costs of developing that software instead of writing them off as they went along.
Yeah.
And when they've decided that software is not going to work, there's no value to that cost anymore, so they do write it off. And that's usually written off as an impairment charge rather than depreciation.
Yeah,
Because depreciation, you're doing it over the life of the income stream. Whereas if there's just no value to it anymore, that's generally considered an impairment charge.
Do you ever do like depreciation and then go, actually, we thought that it had a useful life of like 10 years, but it's really going to be 5. And so now we're just going to, is fully depreciate the same as writing off? Like,
yes and no. You can fully depreciate something and still be using it.
Yeah.
Yeah, I worked for a company that really never got rid of old plant and equipment. So it might have been assessed at the start as having a useful life of 10 years, and some of this stuff we were still using 35 years into the business because it still worked.
Yeah.
So
unlike that software.
Why would you get rid of it? So in that case, it had been fully depreciated, so it had no value sitting in the books, but we were still using it. What you don't have the ability to do under the accounting standards is increase the value of an asset after you've written it off. So you can only write it off over time. You can't come along later and say, oh, actually, I still think this is worth $50,000. Let's write it up by $50,000.
Yeah. In the example of your floors, though, like if you had fully depreciated that building and then you went and put the special floors in, the floors would just be a new asset that you would.
They might be a sub asset of that building. But that would actually increase the cost, and then you would start depreciating that again.
Yeah, cool. Okay, thank you.
Having said that, the only time that you can actually increase the value of an asset to what it's actually worth is in a business sale. So if one company is buying another company, they might get an independent valuation done of all of the plant and equipment, and then they'll take it up in their books at that valuation at that point in time. And then they can start depreciating it from that value. But what that means is that the business that sold the assets effectively made a capital gain on selling those assets because the acquirer paid more for those specific assets than what they were in the books for. That all tends to come out in the transactions with a business sale. If you're doing more value on the plant and equipment than what it's in the books at, that generally winds up with a lower figure for goodwill for the purchaser. So the other thing that you should do with the P&L is to go through and compare the numbers to prior years and to the budget, if there is a budget. There should always be a budget. If not a budget, there should be a rolling forecast. I tend to prefer rolling forecasts to budgets because they tend to keep up to date with what's changing, whereas a budget is often set and forget. So, for example, if we go back to the P&L there, if everyone was to have a look at that P&L, just comparing the 2 years, what are the sorts of things you might want to question? Audience participation, I love it.
Why are we spending so much less on travel this year?
Yeah, that's a good question. I don't know. But yeah, I'd be asking that question of management.
Yeah. Because that's like big, right? It's like in terms of
yeah, it's not huge in dollar terms, but it's a big change.
Yeah.
Well, spend so much more in research and development.
Yeah. So now in that case, you might already know that we have a new project underway, and we've approved the budget for that project. That's in line with what we're budgeting for our research and development expenditure. So you might not need to ask a question on that. But if you saw that without any background and without having approved the capital for a new project or the expenditure on a new project, you might look at it and go, well, hang on a sec, what's going on there? There'll be more on that later when we look at the balance sheet and the cash flows.
Hey, can you just explain what bad debts are?
He's gonna ask. Cool.
Okay. Bad debts are the trade debtors that aren't going to be able to pay you. They're the where you write them off. So, you know, if, for example, you'd sold a whole lot of stuff to Jenny Craig, Jenny Craig's gone into administration, the administrators might come out in 2 or 3 weeks' time and say there's only enough money there for the creditors to get 5 cents in the dollar. In which case, if they owed you $100,000, you'll get paid $5,000. The other 95,000 will have to be written off, and that's what it will appear as. You might often see that line as a bad and doubtful debts provision, because a lot of organisations will have what they call a provision for doubtful debts that they will take up as a contra to the trade debtor. Now, what that is they haven't identified any specific debtors that aren't going to pay them, but they know from past history there will be debtors in there that will not pay them. They just don't know about them yet. So they take up a provision to allow for that. And then when the debt is written off, it gets written off against the provision instead of going to the expense.
Well, I guess my question then would be, you know, why have their bad debts increased so much? And then, you know, does that mean that in future they might need to be a bit more careful about who they're dealing with? I don't know, do a bit more homework on what their financial situation is or something?
Absolutely, perfectly valid question. So, yep, that's exactly the sort of thing you should be asking. Another thing that I sort of noticed looking at this is, you know, we've had a reasonably good increase in sales. It's gone up almost $300,000, but our gross profits hardly changed because our cost of sales has gone up by the same amount. So we don't know why that's the case. We don't know if it's volume related. We don't know if it's price related. You know, you might have 50 different items that you sell. Some of them might have lower margins than others, and you've done a really good job of selling the things that have a lower margin. So, yeah, or you might find that your suppliers, like over the last year, all the suppliers have put up their pricing, and you've put up your pricing effectively just keeping pace with it. So, but yeah, you would expect that if you'd had a $300,000 increase in sales, which is just over 10%, you would expect that your profit might have gone up by just over 10%, which it hasn't. So another thing might be bank interest. Your bank interest was 26,000 last year. It's only 9,000 this year. So, you know, you might have a question about why our interest has gone down. Interest rates are going up. Why are we paying less interest? So, yeah, but a lot of the other things are quite consistent. I mean, marketing expenses have more than doubled. That might have been what generated the extra 300,000 in sales. And it's just unfortunate that the cost of sales has gone up through other external impacts. So
No one got a pay rise.
well, you never know. Someone may, or everyone may have got a pay rise, but they might have 3 less staff. Again, the number by itself doesn't tell you what's happened. It just tells you that either something's changed or something looks like it hasn't changed. That number there might tell you might indicate that nothing's really changed, but there could have been a big change underlying that we just don't know about. So just from these numbers only anyway. So they're the sorts of things you would look for in a profit and loss statement. So the next, before I go on, any more questions? I have to keep catching myself. You're getting really good at asking them on the way through, which is good because that's what I prefer.
The only question I had, sorry, Tony, and you may have covered this, I just had to answer the call. But cost of sales, I imagine the breakdown of that in regards to the raw materials and the equipment that's required to build a product is captured elsewhere.
Usually, yes. With a manufacturing business where you are actually making the products yourself, that will be a combination of the cost of the materials that go into making it, the cost of the labor that goes into making it, the cost of the direct expenses that go into making it. So things like electricity, that sort of thing. And then there will also be an allocation of indirect expenses or overheads that will get taken up into the cost of those goods as well. So
Yeah.
that will be a portion of the rent for the premises that the production's done in, charge for admin staff effectively that work in the production area. It wouldn't generally include a charge for people like the accounts receivable and so forth. That's usually not included in your product costing. But yeah, for a manufacturing organisation, that can be quite long and involved.
Yeah. And so really the expenses on this is the operational expenses, because particularly that IP expense could potentially be cost of, well, that's not cost of sales, that's cost of product, isn't it?
Yeah, we'll talk a little bit more about that one later.
Yeah, right. Okay.
But yeah, for example, your cost of sales there might be perfectly fine for a retailer.
Yeah.
Because the only thing that would be in the cost of sales would be the purchase price for what they bought in to sell.
Yes. Yeah.
So it depends on the type of business.
Yeah.
If it's a service business, you would potentially split your salaries and wages between overheads. So people like your CEO, your financial controller, and so forth, and the people that actually provide the service, their salaries and wages might be up there in that cost of sales area. So the people going out providing the training services or whatever they happen to be doing. So just because it's salaries and wages doesn't mean it's going to be in a particular area. What's important is what the people are actually doing and which part of the process they're adding value to.
Okay, thanks.
So moving on to the balance sheet or statement of financial position, there's this thing called the accounting equation. You will often see this shown two different ways. I prefer this one, so this is what I'm telling you. Assets less liabilities is equal to equity. Now, what this effectively means is that everything that you own is here. So that's the value of what you own, less the value of what you owe to someone else, is equal to the value that you have from owning all of those things. Now, a simple way to think of that might be if you own a house, the value of the house is your asset, the value of your mortgage is the liability, the equity is the difference between the two. So that's the value that's left to you if you were to sell that house and pay out the loan. Similar thing with a company. Everything that has value to you is an asset. Everything that you have to pay to someone else effectively, either now or into the future, is a liability. And the equity is what's left over for shareholders. So now that can either be distributed to the shareholders in a for-profit company. And that can be either done as a dividend or on winding up, it might be a capital distribution. If it's a not-for-profit company, they're not allowed to distribute that. So that gets retained in the business and it will be used in the future to provide services. If that not-for-profit entity closes down, generally speaking, the constitution for that entity will say that any net assets have to be transferred to another organisation with a similar purpose. So at no point in time can that equity in a not-for-profit company come back to members. And that's one of the conditions of getting a tax deduction, or sorry, a tax-free status of not-for-profit. This is what a typical balance sheet would look like. This is for exactly the same company that we had the P&L for. So the numbers in here will actually line up with what we were looking at in the P&L, insofar as there's a change. I'll come back to this in a minute, but you can see it's structured with current assets. That's everything that you expect to convert to cash within 12 months. Non-current assets is everything you would expect to convert to cash in a period longer than 12 months. Now, by converting to cash, you can either do that by selling it or by using it. So if it's plant and equipment, as you're using it to manufacture goods, you're effectively getting value from that plant and equipment that is going into the cost of what you're making. So That gives you a total assets figure. So 1.2 million can be converted to cash within the next 12 months. In fact, 374,000 of it is already cash. You would expect to collect all of your trade debtors, and you would expect to turn over all of your inventory within a year. Most businesses would look to turn over their inventory within 60 to 90 days for a manufacturing organisation. The non-current assets are your fixed assets, so your plant and equipment, your capitalised research and development, and your intellectual property. Then you've got your liabilities. Again, the current section is anything that you will have to pay within the next 12 months. So you've got your trade creditors there. They'll generally be paid within 30 days. Your GST payable, which is obviously paid to the tax office, and a current leave provisions. So that's all of the leave that you expect your employees to physically take within the next 12 months. So each employee might get 4 weeks annual leave a year, but if you only expect them on average to take 3 weeks of it, you would only have 3 weeks in the provision, and you would have 1 week in the non-current provision, because 1 week of it will be taken more than 12 months out. Now, the determination of the value of those provisions and the split between current and non-current is again a very technical area that the accountants will fight over. In the old days, you used to take up a leave provision by looking at what was the employee was entitled to and multiplying it by their salary. And that was the provision. Under the accounting standards, that's not going to be reflective of what the true outstanding amount is going to be. So what you need to do with a leave provision these days is for all of your staff, you need to work out the likelihood of them getting to a certain number of years of service, the probability of that effectively, work out what their salary is likely to be in, say, 10 years' time when they qualify for long service leave. Then you need to discount the value of that long service leave they would be entitled to in 10 years' time by, firstly, the likelihood that they will get to 10 years service, and secondly, by a discount factor to take into account inflation. So it is quite a long and involved calculation, and it's based on each individual firm's staff retention history. So you can't just look at it and go, okay, on average in this country, 20% of people will get to qualify for long service leave. Doesn't always work that way. For example, where I was at Everhard Industries, we had incredibly long staff retention. You know, we had about 250 employees around the country. We had 52 members of our 20-year plus club. So a fifth of our staff had been there for more than 20 years. Yeah, the longest serving one I knew had been there for 43. So, and they weren't family members. You know, they were, you know, working in either the precast concrete plants or the injection molding plants, or, you know, they're just like a family. So, yeah, when it came to leave provisions, we would have had higher leave provisions than, for example, KFC or a Subway might have, where they turn over their staff on a fairly regular basis. So, as I say, again, you've got your liabilities, which is split between current and non-current. If you've got a bank overdraft instead of cash at bank, that will appear in the current liabilities instead of appearing as a negative amount up here. So you've got your total assets of 1.6 million, total liabilities of 162,000, gives you net assets of 1.4 million. So that was that accounting equation I spoke about before. Assets minus liabilities equals equity. Now, when we have a look at the equity section of that balance sheet, there's $10,000 worth of issued capital. So that's the shares that were sold to shareholders initially. at the value that they were sold to the shareholders initially. And then the second line is retained earnings. Now, what retained earnings is the total amount of profit this business has made since the day it was established, less whatever it's paid out in dividends. So, which brings us back to the next point. Jason, it's 3 slides on. So I might finish talking about the balance sheet first, and then we'll talk about how the balance sheet and the profit and loss link to each other, and then we'll go back and have a look at the amounts that are in the balance sheet as well. So assets include things like cash at bank, debtors, inventory, plant and equipment, and any other asset that can generate cash into the future, whether that's intangible assets like trademarks, research and development expenditure, brands. Quite often brands will have a value that is recognised on the balance sheet. They can be independently valued. Deferred tax assets, where I was saying before that your taxable income will be different from your profit and loss in your financials. That's only, generally speaking, that's due to timing differences. So you get to claim a deduction for tax purposes earlier than you take up the expense for accounting purposes. In that situation, you will wind up with what's known as a deferred tax liability. So you don't have to pay the tax now, but you will in the future when you've got the expense in your P&L, but you don't get to claim the deduction because you've already claimed it. So, and effectively that changes over time depending on the difference between your profit and loss and your taxable income. Liabilities are things like borrowings, creditors, and employee entitlements. So anything that's owed to anyone else. And I've already spoken about the equity. So everyone can have a look at that. Did you all get these emailed out to you? Awesome. So you can have a look at it later. And I'm happy for anyone to contact me at any stage after the sessions. And if you come up with a question, that's not a problem at all. When you're reviewing the statement of financial position, just like with the profit and loss statement, there's a whole lot of questions that you need to think about. Now, does the company have the necessary financial strength to survive? So, does the business have enough current assets that you can readily convert to cash to pay the liabilities that are due to be paid within the next year? So if we look at the balance sheet, we've got 1.2 million in current assets, which are due to come in as cash during the next 12 months. We've only got $150,000 worth of current liabilities. So there's going to be more than enough cash there to pay the liabilities that or the current liabilities that we've got. In fact, there's more cash there now than the total of those current liabilities. You don't even need to have collected the debtors or sold the inventory. Is there too much debt in the business? So if we come back to the balance sheet, where's the debt? Can anyone point that out to me?
It's in the liabilities.
That's right.
The liabilities is the debt accumulation of.
Okay, yes, that's true. I was thinking specifically of the bank loan.
The bank loan, yeah, which looks like it's paid off.
Which does look like it's paid off. Now, and you'll notice that last year it was shown as current.
Yeah.
There's nothing in non-current. So last year they knew that they were going to be paying it off this year.
Mm-hmm.
So now if you think back to the profit and loss statement, remember we saw the interest expense had dropped quite a lot. And I said that seemed strange when interest rates were going up. The reason the interest rate expenses dropped is because they paid off the loan.
Mm-hmm.
Now, they may have paid off that loan in October, November. So there might have been 4 or 5 months worth of interest there, which would explain the $9,000 that was in the P&L, but nothing after that. So, the combination of looking at the expense in the P&L and the movement in the balance sheet can quite often give you a lot of information about that as well. If you hadn't picked up on that and you'd asked management to explain why the interest expense had gone down, that's what they should have come back and told you. It's because we paid off the interest-bearing debt. So, so is there too much debt? Well, at the moment, there's no debt. They've paid it off. So the answer, you wouldn't even ask that question if you'd had a look at that. Are the asset values appropriate? For example, are the debtors collectible? Are there debtors in there that aren't going to pay you? Can inventory be sold for more than what it cost? Can plant and equipment either generate cash flows through its use to justify its value, or is it able to be sold for more than the book value? They're the sorts of things that you would do to assess whether the value of those assets is appropriate. Now, with debtors, for example, if you decided that they were overstated, you would take up an increase to the provision, which would create an expense in the P&L for bad and doubtful debts provision. With inventory, you would actually write down the value of that inventory. So that would wind up as expense in the cost of sales area. So again, not having a breakdown of what the cost of sales is made up of. Part of the reason for that cost of sales going up by the same amount as the sales might have been a whole lot of old inventory that got written off. And that would have thrown out the cost of sales. Because effectively what that is doing is writing off material. It's just an assembled material or a raw material. Are there any liabilities that are not recorded? So, do you know of anything that is coming up that you're going to have to pay that isn't in that balance sheet? So it's also a good general question to ask of management, make them think about it too. Are there any borrowings that are coming due, and can the company pay or repay them or renegotiate them? So, if you've got a 5-year loan with the bank, which is coming due next year, are you going to be able to repay that entire loan to the bank, or is the bank going to be happy to roll it over for another 5 years? You need to find that out before you prepare the accounts, because the answer could drastically change the accounts. You might have something that's been sitting in non-current assets, which all of a sudden you've got to take up as a current asset and find the money to repay. With bank loans in particular, they generally have a whole section on what they call covenants to the bank loan. Now, what they are requirements that the bank has put on the business in order for the business to be granted the loan. Now, the sorts of things that they might have in there might be a thing on interest coverage. So they might want the net profit of the business to be at least 5 times the interest bill. It might be around gross profit percentage. They might want you to achieve at least 32% gross profit. And if you actually only achieve 29% gross profit, you've effectively breached that covenant. The effect of breaching a covenant might be that that entire loan becomes repayable at the time you breach the covenant. So instead of having 3 more years to pay it off, you might be in a situation now where you've either got to find someone else to refinance it or find the cash from somewhere else to pay it out. Now, all of the covenants will be specific to each business, and the bank will determine what they think is important for the security of their funds that they've lent to the business. So they're the sorts of questions you would want to ask on a balance sheet. Does anyone have any questions on that? Well, let's go back and have a look at the balance sheet. If you're looking at these numbers, what might you ask questions on? Okay, how about trade debtors? That's gone up by just under $100,000, which is about 25%. And we had about a 10% increase in sales. So trade debtors have gone up by a lot more than what your sales have gone up by. That could be a timing issue. You might have had a really big sales month in June. They might all be current debtors. They might all be collectible. But if the sales were spread fairly evenly over the year, you might have a problem with collectability of those debtors. Now, remember in the P&L, someone commented that we had quite a big bad debts expense for the year. I think it was $54,000. So if we hadn't written off that $54,000 worth of bad debts, where's my mouse going? There we go. That figure of $532,000 could have been $586,000. So someone's obviously looked at it and gone, 586,000 isn't right. We need to write some of this off, which is what you've seen in the P&L. But the question is, have they written off enough? Should they have gone further? That's going to depend on an individual analysis of the debtors within that debtors ledger. Quite often, a debtors ledger will be what they call stratified. So they'll look at it and they'll see $532,000 in total is owed to the company, but 400,000 of that is in current. 100,000 of that is in 60 days, and the rest is in 90 days plus. So they'll have a look at that and go, okay, based on the fact that most of it is current, it's probably collectible. Let's have a look at the ones that are in 90 days and see if we should be taking up a provision for those. Or is there some reason why it's in 90 days? For example, we might have a particularly big customer that we've given 90-day trading terms to. So they only have to pay their bills 3 months after we invoice them. And as long as they have a history of paying it at that 3-month point, you wouldn't need to take up a provision for it, even though it was at 90 days. Inventory's gone up slightly. There's probably no real concerns there. Your fixed assets at cost has gone up, so you've obviously bought some new plant and equipment through the year, and your accumulated depreciation has gone up as well. So that will be an addition of the depreciation for the year. So if you were to go back and look at the P&L, there would have been a value in there for depreciation. The difference between the 113,000 and the 74,000 would be what you put through to the P&L as depreciation. Research and development capitalised has gone from 372,000 down to 262,000. Now, I will just run back up to the P&L because someone made the comment before about research and development expenditure had gone up. Well, in actual fact, what they've done is they've written off part of the asset that they had capitalised. So that money wasn't actually spent this year. It was spent in prior years and capitalised, but for some reason, either they've started selling the product or they've decided that the product doesn't have enough value to warrant the amount that they've capitalised for that research and development. So they've actually written off some research and development. So that's not actually money spent on research and development. It's getting rid of the excess value in the asset. And the same thing where someone commented on the intellectual property expense, how that was exactly the same as the year before. If we come back to the balance sheet, you'll see that we had 46,000 the year before, 34,000 this year. So that intellectual property was capitalized some stage in the past, and it's being written off at $12,000 a year. So it might have been originally $60,000 to be written off over 5 years. So it's now down to $34,000. So it's got three and a bit more years to go, or just under 3 years to go.
Excuse me, Tony. Can you give an example of research and development capitalized? What is that? Is that like you've received a grant or?
No, that's money that you've spent doing the research and development. Right. But instead of putting it through as an expense to the profit and loss, you've decided that there's enough likelihood that that research and development expenditure will generate a new product for you in the future that you're going to be able to sell and effectively recover the cost of that investment in research and development.
Okay.
And if there's a high enough degree of certainty for that, you can actually capitalize that onto the balance sheet and then start depreciating it when you start selling the product. So you're effectively matching the cost of developing the product with the period of time where you're getting the income from selling that product.
Thank you. I think
No
I'm
worries.
starting to get it.
Oh, it can take a long time. I've been at this for 40 odd years.
Tony, how does that R&D work if you're in an industry that can do an R&D tax incentive, which then becomes income?
Yep. In that case, generally speaking, you are only capitalizing the portion that hasn't been funded by the incentive.
Okay, yeah.
So you generally offset the research and development against the incentive and capitalize the extra.
Okay.
So
okay, that makes sense.
where are we up to? Okay, so with the financial statements, we've spoken about the statement of comprehensive income and the balance sheet. Now, the statement of comprehensive income is actually the link between two balance sheets. So if you remember, the profit and loss is over a period of time. The balance sheet is as at a point in time. So it's a balance sheet as at 30th of June or as at 30th of June the year before. So it's a snapshot of what you own and what you owe at a single point in time. The statement of comprehensive income is the difference between the two balance sheets. So if you've got a balance sheet at 30th of June 2021, another balance sheet at 30th of June 2022, and the equity has gone up by $150,000, that will be because you have a net profit of $150,000. And that always has to be the case. Except in a for-profit company, in which case you might have had $180,000 worth of net profit and paid out a $30,000 dividend. But that's just effectively paying out some of that profit and not keeping it in retained earnings for the equity area.
Sorry, Tony, can you say that again? The statement of comprehensive income.
Yep.
So the balance sheet is at a point in time. What is the
Yep.
statement of comprehensive income again? Sorry.
It's over a period of time.
Okay.
So if we come back to the profit and loss, you can see it's profit and loss for the year ended 30th of June. So that's 12 months worth of transactions. If we have a look at the balance sheet, that's the balance sheet as at the 30th of June 2022 and the balance sheet as at the 30th of June 2021. Now, I'm not going to be able to do the numbers in my head, but if you look at retained earnings, it's gone from 1.171. I get to click on it and it moves slides to $1.423 million. So it's gone up by, what's that? $250,000 thereabouts. If we go back to the profit and loss, there you go, $250,000. So that 252,640 will be exactly the difference between the 1.171 and the 1.423. And as I said, that must be the case unless you've distributed some of your retained earnings to shareholders as a dividend. But then you'll generally have a little section in the notes of the accounts that will show you that distribution and how it's worked and how the opening retained earnings reconciles to the closing retained earnings. But you will always be able to see in that reconciliation the net profit for the year after tax. So while we're talking separately about profit and loss and a balance sheet, they really are intertwined. You generally cannot change one without changing the other. The only time that would happen is if you decide to, for example, reallocate an expense. So if you decided that you'd put something to communications, but it was really an electricity bill, and that would just shift within the P&L, and there'd be no change to the balance sheet. But if you found an extra invoice for rent that you hadn't taken up, when you take up the expense for the rent, that's then going to decrease your retained earnings. So you'll have less profit and less retained earnings. I'm getting the feeling.
Excuse me, Tony. Sorry, and for
Yep.
tax purposes, which one is the one that you have to submit to the ATO? Is that the balance sheet or the P&L?
Neither. It's
Oh,
the tax return is based on taxable income less allowable deductions. So, and that is closest to your profit and loss, but it won't be the same as your profit and loss.
okay. Okay.
So,
Thank you.
for example, in the budgets for the last few years, small businesses have been allowed to write off any assets that they buy. And that was a stimulus measure that was done to try and improve productivity in the economy. So what will happen is if you buy an asset, you pay for that asset, you put it on the balance sheet, you start depreciating it. So your P&L will have the depreciation for maybe 1/10 of the value of the asset each year for 10 years. But your tax return will claim the entire value of the asset in the first year as a deduction. So the two things can be different. Yeah.
Okay. And
In most cases, you're looking for the differences. The majority of it will be, sales will be sales, regardless of whether it's income purposes or income tax purposes or accounts purposes. But there will be things in there that make them different. And generally speaking, another thing that you will find in your notes to the accounts is a reconciliation between your profit and loss and your taxable income.
okay. Okay. Thank you.
Okay. So, as I said, all of these accounts, all of these financial statements are linked together. Change one, you'll change another. The next one I'm going to talk about is the statement of cash flows. Now, where the profit and loss is the movement between two balance sheets, the statement of cash flows is the movement between 2 points in time of your cash at bank. So no other assets or liabilities, only the movement in cash. Now, the statement of cash flows is broken up into 3 sections. The first one is called operating cash flows, which is the cash generated by running the business. So that's where your receipts from customers for sales will be. Now, that will not be the same as your sales for a number of reasons. It is actually the cash you have received from the customers during the year. So if your debtors have gone up or down, that will cause a difference because you've taken up the sale, even though you haven't got the money yet. For the cash flow, you only take it up when you physically get the money. The other difference is GST, because when you take up the debtor includes GST, but the sales that appear in the P&L do not, because the GST goes to that GST payable account, and the difference between the GST you charge and the GST that you pay on things that you buy gets paid to the tax office. So when you are collecting money from your debtors, you are collecting 10% more than the value of the sales that you are showing in the P&L. So it is difficult often to reconcile between the statement of cash flows and the P&L, but it's possible. And it is possible for every business. It can tax people. The other thing that goes into operating cash flows, which is a little bit different to dividends, is any interest you pay on borrowings. That's part of your operating cash flows because that's part of the cost of doing business. The next section is investing cash flows. So operating is from running the business. Investing is from buying and selling assets, whether that's plant and equipment, buildings, shares, investments in exchange traded funds, whatever the investment might happen to be. When you buy a new piece of plant and equipment, that is a cash outflow from the investing area. And you've got to remember, within the operating cash flows, depreciation will not appear because that is not a cash entry. Because you actually pay for the item when you buy it. The depreciation is just writing it off over time. No actual cash goes out the door for depreciation. If you sell a piece of plant and equipment, what you get for selling that plant and equipment is also in the investing cash flow area. It's not part of your operating cash flows. So the final section is financing cash flows, which is effectively where you get the funds from to run the business. So that is either a new loan that you might take out or a repayment of an existing loan. That will be either an inflow or an outflow. But the interest on that loan will be up in the operating area. You might issue some new shares. If you're a company on the stock exchange, you might decide that you're going to issue another 100,000 shares at $5 each. The money that you receive for that will go into here. If you decide that you've got a whole lot of extra cash at the moment and you don't have a very good use for it in the business, you might do what's known as a share buyback. So you might say that our shareholders have better things to do with this money than what we do. So we're going to offer to buy back some of their shares at a certain price. And in which case the company then decreases the share capital in the balance sheet and pays the cash out to the shareholders to buy back those shares. That would appear in the financing section, as would any dividends that are paid out. Because a dividend is not a cost of running the business. It's a distribution of the profit after running the business to the shareholders. So your statement of cash flows will look like this. You'll have your cash flows from your operating activities. And generally, it doesn't give any more detail than this either. So you'll have receipts from customers, less payments to suppliers, coming down to interest paid. Less your interest paid, coming down to your net cash flows from operating activities. Your cash flows from investing activities, you can see that we purchased $45,000 worth of plant and equipment. If you remember back in the balance sheet, we saw plant and equipment went up by $45,000. That's the other side, effectively, of that. That's where the purchase of that plant and equipment has happened. Looking at capitalized R&D and intellectual property costs, you can see that we spent money on both of those areas in 2021, but we haven't spent any money this year in either of those areas. So the expenses that were in the P&L were purely writing off previously capitalized R&D and intellectual property. There was no new investment in those areas this year. And the final section, the financing, remember that bank loan got repaid? That $280,000 is the repaying of the bank loan. So the way to read this cash flow statement is you can see that from running the business, we generated $316,000 worth of cash through the year. Of that $316,000, we spent $45,000 buying some new plant and equipment, and we repaid a bank loan of $280,000. So for the year, we spent $9,000 more than what we received. Now, the cash that we had at the start of the year was $382,000. So at the end of the year, we've got $374,000 because we spent that $9,000 that was there at the start of the year, as well as everything that we earned through this year. Now, if you just remember in your head the 382 and the 374, we'll go back to the balance sheet. And you can see that cash at bank was 382 last year, 374 this year. So that statement of cash flows explains where all the cash went for the year. So unlike the profit and loss, which is done on an accruals basis, so it's done by when expenses are incurred, when a sale is made, that sort of thing. The movement in the cash is purely that. It's the movement in the cash. But again, the cash flow statement will link back to your profit and loss and to the balance sheet. So if we come down to what you look for when you're reviewing the statement of cash flows, the most important thing is to make sure that that first section, the cash flow from operations, is positive. So if we look at that, you can see we've got positive cash flow both years. That's the cash that you are making from running the business. This is the cash that you are the investing activities is the cash that you are spending or getting from buying or selling assets. And the last one is the funding section. So that's the cash that you are getting or spending from either banks or shareholders. So the important thing is that this cash from operations is positive, because if that's not positive, your business is not making cash. So if it's negative for a short period of time, that's okay, because that shortfall can be made up by either selling assets or issuing new shares, which is financing, or borrowing money from a bank, which is financing. If it's negative for a long period of time, then it's a problem, because eventually you'll run out of assets you can sell, and no one will be prepared to invest in you, and no one will be prepared to lend you any money. That's when you will become insolvent. So the cash flow from operations is the most important part of that cash flow statement. If your business is generating cash, it can then do these other things and manage these other things. If it's not generating cash, you need to have a plan for how you can get it back to generating cash. Does that make sense?
Yes, that makes sense to me, and I think that's a pretty important
Awesome.
part of running a business, isn't it? Like
It is.
a lot seems to rest, or a successful one. And I think you know, if there were issues, maybe you know, you'd look. Well, one thing you might look at would be going back to the you know, if there's been an increase in sales, as it were, and
Yep.
in a year, but then also quite a big increase in costs of sales, and then I think look at, you know, hang on, if we're selling more, surely we should be making more money, actually have more cash in the bank.
Yeah, and it might also come down to your debtors as well. I mean, you might have had a 10% increase in sales and a 50% increase in your debtors. So you've sold it, but you haven't actually got the money in yet. So, and that can cause you a short-term problem, because the money's due. It should be paid if your credit processes are correct, and eventually you should get that money. But you might come to a crunch point where you need some funding to get you through until that money does come in.
And they've made the decision to pay down that loan as well, which you would think, you know, we'll have a year that doesn't look so awesome, but then in the following year.
Yeah, well, as you can see, the cash only went down by $9,000, and they managed to clear $280,000 worth of debt, plus buy $45,000 worth of new plant and equipment. So, yeah, they're doing pretty well. These guys don't actually have an issue with the ability to pay their debts. So, yeah, I try not to make things look bad all the time.
I still do, though, look at it and go, $340,000, that's a whole lot of accounting activity for like,
yeah. If there's a little bit of time at the end, I'll show you the spreadsheet where I put all that together so you can see how it all links. But that's more an interest thing than a nice necessary thing. The next section I wanted to talk about was the notes to the accounts. So remember I said at the start that the notes to the accounts provide the additional information. So that it's not things that are actually necessarily assets and liabilities. It might be. It might be just explaining how you've gone about valuing your inventory. It'll provide more information on that. Or it might be what I was talking about before with the contingent liabilities. The other sorts of things that you'll talk about there is if there's been a significant change in your accounting policies. For example, if you've gone from valuing your inventory on a standard cost system to a first in, first out system, that can have a massive impact in the year that you make the change. So you need to tell the people using the accounts, A, that you've made that change, and B, what the impact of that change has been. So that they don't look at the stock value and go, oh, gee, stock's gone way up or way down, without knowing that, well, stock's actually the same, it's just valued differently. So you need to tell people all of the judgments you've made and the key sources of estimation or uncertainty. So, for example, you need to tell people the figures that you've used in determining your leave provisions. So the likelihood that people who have been here for 1 year will stay 10 years is X. The likelihood people between 2 and 5 years will stay 10 years is Y, that sort of thing. More details on revenue, expenses, assets and liabilities. So where I said before, the P&L might just have sales. In the revenue note to the accounts, you might actually show that sales broken up, say, geographically. So you might have sales in America, sales in Australia, sales in New Zealand shown separately coming to the total, or you might have it broken up across business units. So, for example, Wesfarmers used to be a really good one. They'd have a whole range of businesses in the rural area selling fertilizers. They had an entire insurance business. They had Bunnings. So they had businesses that operated in a whole lot of different areas, and they would often show their retail business separate to their agricultural business, separate to their insurance and financing business. So, but at the end of the day, the total revenue would be right. They're just showing you how much of that was Bunnings and how much of it was the other ones. Employee benefits I've spoken about, contingent assets and liabilities I've spoken about. Contingent asset, for example, that's often a hard concept for someone to get their head around. There might be a situation, say, in a not-for-profit, where the not-for-profit has received a bequest of a house from someone in their will. That will has been contested by some of the children or something. So rather than take it up in your accounts, you might put in the notes to the accounts that there's a contingent asset there. The value of the house is X. It's being contested by the children. We're trying to come up with a solution at the moment. We'll provide more information when that settles. So the users of the accounts know that there's something that might happen, and they know roughly what the financial impact of that might be. But that's the flip side to the liability with the legal case. Subsequent events is another note. So you're preparing your financial statements for the year ended 30th of June, 2022. Your business is based in Christchurch. They have a major earthquake in September of that year. The accounts are signed off at the end of October. The earthquake is going to have a massive impact on your financial statements, but it doesn't change the values that were there at the 30th of June. But you need to tell people in the notes to the accounts that since the end of the year, we've had this earthquake. It has wiped out 3 of our 5 plants. We're not going to be back in full production for a year and a half, something like that, and estimate what the financial impact of that might be. It could also be a positive subsequent event. You might have picked up a deal to supply all of the beef to McDonald's in Australia, for example, which wasn't there or known about at the 30th of June. And there's usually a note on remuneration of auditors. So it tells you how much that you pay the auditors for firstly auditing the accounts and secondly for any other services they may provide. And you have to show those separately. So in some cases, the auditors might also prepare the financial statements if the business isn't big enough to have accounting staff that are able to do that themselves. So in which case they would charge, $10,000 to prepare the accounts and $15,000 to do the audit or something, and you'll show those amounts separately. Any questions?
I was just going to ask a quick question. So I think in terms of the remuneration to auditors, I've worked somewhere where they had like the board had actually put like a rule in place where the auditor wasn't allowed to earn like to do services outside of auditing above a certain kind of cap. Would that be in there as well, that they stuck within that? Yeah, okay.
Absolutely. That's actually very common. And again, I'll talk about that in a couple of slides' time.
Oh, sorry.
That's okay. So these are the sorts of things that you would have in your notes to the accounts. I don't plan to go through any of this, apart from point out that wherever I copied this from, they didn't do a very good job because we've got 2 4s and no 5, and the second 4, we don't know what it is. So, but that was just an index to a set of accounts. So the next thing is the director's report and declaration. Firstly, the director's report. That is basically a letter to the shareholders or the members telling them about the business, telling them what the business does, how the business is going, what future developments the board see for the business. We plan to move into this area, or we're going to look at moving out of the Indonesian market, or whatever it might be. It'll tell you who the directors were for the year. It'll usually tell you if someone's resigned through the year, the date that they resigned. If a new person was appointed, the date they were appointed. It'll usually tell you the number of board meetings that they were a director for and the number that they attended. Quite often it will talk about things like environmental regulations. So this is where people will talk about their green credentials. There's been a lot of ASIC enforcement lately around greenwashing, taking people to task on making claims that they just can't back up. Generally, that sort of thing is done here, not in the notes to the accounts or the actual financials. Any options that have been, share options that have been given to employees, what the hurdles are for them to earn them, that sort of thing. Whether there's been any indemnification of officers and auditors. That's where the company agrees to pay any liabilities that might be incurred personally by directors or senior staff or auditors. So, for example, if someone sues the CEO for defamation, the company might agree to cover the cost of that. Generally speaking, there will be a directors and officers insurance policy in place. And generally speaking, if some claim like that is made, any sort of defence or whatever will be run by the insurance company that policy is issued by. And then there's a statement on the auditor's independence declaration. Now, the director's report is the only thing in the accounts that the auditors do not audit. So the things that are said in here, the auditors don't have to verify. What they have to do is review it to make sure that nothing is said in here which is contradictory to anything which is in the accounts. So, but in a lot of these cases, the auditors aren't going to be able to audit what future developments of the company might be, for example. They're not going to necessarily have the skills to determine whether the company has met a zero carbon target or whatever it might be. The second thing that the directors have to do is what's known as the director's declaration, and this is governed by the corporations law. The things that the directors have to state is that there are reasonable grounds to believe that the company will be able to pay its debts as and when they become due. And you have to have reasonable grounds for that. So before you sign off on something like that as a director, you would want to have some backup that the company can pay its debts as and when they fall due. Don't blame me for this next one. It is straight out of the legislation and it makes no sense to me, because what it says is that if the company has included in the notes to the financial statements an explicit and unreserved statement of compliance with the IFRS reporting standards, that this statement has been included in the notes to the financial statements. It's sort of like saying, you're going to say this and you've said it, but now you have to tell us that you've said it. And it's very poorly worded. What I think they're actually getting at there is if you have to comply with the national accounting standards, you have a statement in your notes to the accounts that says you have to comply with it and that you have. So, which is the way I would have expressed it, but I'm not a constitutional lawyer. You have to say that the financial statements and notes comply with the accounting standards. That's from section 296. That one, that convoluted one, and the reasonable grounds is all section 295. You have to say that the financial statements present a true and fair view of the financial position, so that the balance sheet is true and fair, and the performance of the company, which is the profit and loss. So both of those you have to say are true and fair. If a company is listed on the stock exchange, you have to say that the directors have been given the declarations from the CEO and CFO as required by section 295. all those declarations are is making the CEO and CFO declare to the board that those things are right. So even though a company is not listed on some of the not-for-profits that I've been on, we've actually required the CEO and CFO to give us this declaration anyway, even though it's not required by the Act, because that gives us some additional comfort that when we're making these declarations in the financial statements, the management effectively agree with us. Now, the director's declaration is audited, unlike the director's report. So the auditors have to opinion on whether the company can pay its debts as and when they fall due, and that the accounts are true and fair, and that they comply with all of the accounting standards. So you also have effectively, as a director, the support of the auditors agreeing with the fact that the statements that you are making are true. Then the bit that we were talking about with the audit report before, we have what's known as an auditor's independence declaration. So the partner declares, to the best of their knowledge and belief, there have been no contraventions of the independence requirements of the Act or any applicable code of professional conduct in relation to the audit. Now, that comment you made before about limiting the fees from other services to a certain cap, that is to do with this. So if an auditor was getting $300,000 to run the accounting system for the year and do the tax returns, and getting $15,000 for doing the audit, do you think they're likely to qualify the audit report and potentially put $300,000 of other income at risk? It's an independence issue. So there's just too much income they're getting from the other services to give the impression of independence. I mean, the auditor may be perfectly independent. They might have, $50 million worth of income from other clients, but it's not a good look. So
would the auditor normally be aware of what kind of cap on other services has been placed on them?
Oh,
or?
absolutely. The audit committee would have discussed that with the auditor in advance. So, and they would usually do that at the time they negotiate the fee for the following year, because usually these fees are all quoted in advance.
It was a bit controversial in that workplace because it was someone who wanted to put themselves in a position to get a lot of IT services that are separate from audit, and they could have made more money. So I think they were fighting internally about it. Anyway.
That becomes an ethical issue as much as a legal one. But this is a good hammer to use to force home that ethical issue. The independent auditors report, basically all the things that they're saying in there are the things that the directors had to say in the declaration. So we've spoken about that. Okay, last slide. We're only run 4 minutes over time at this point. So in the PowerPoint you'll be able to click on these links, and these will take you to some sample financial reports for the 2022 year that have been prepared by KPMG and Deloitte. The KPMG one and the Tier 1 Deloitte one should be very similar. The Tier 2 one is Tier 1 and Tier 2 reporting. Tier 1 is a general purpose financial report. So that's where there are independent users who don't have the ability to get other information. A Tier 2 organization is where there are a limited external users that can't get that information. And they have simplified disclosures. So they don't have to give as much disclosure information in the notes to the accounts as the full Tier 1 accounts, but they still have to comply with all the measurement standards. So inventory still has to be lower of cost and net realizable value, all that sort of stuff. But they might not have to disclose anything about share options, particularly if they're not for profit, because they won't have any. That sort of thing. So that really brings us to the end of today's session, but I am happy to hang around if anyone has any other questions. We will obviously have a lot more of this on Thursday, particularly a lot of the director's duties. I know you would have covered director's duties in some of the other sessions that they run, Some of it might be a recap, but I've tried to concentrate on the ones that are important for financial purposes more so than other areas.
Thanks, Tony. That was really cool. That was a good summary of a very difficult conversation.
Yeah, so
Or a very difficult topic, I should say.
as a director, you don't have to be an accountant, but you have to provide the appropriate level of diligence and thought to assessing the accounting as you would any other part of the business. And that's your requirement as a director.
Yeah.
On Thursday, I might even talk about some of the court cases that went on with Centro and that sort of thing. They're fairly typically used as examples for issues where directors have had a problem, but not because they were expected to be accountants, because they should have been aware of the issues and didn't pick them up. So, but we can talk about that on Thursday. So I look forward to seeing everyone then.
Okay, I'm going to
Tony,
run. Thanks,
Okay.
everyone.
Thank you.
Thanks very much.
Thanks.
Thanks, everyone.
Thanks so much.
See ya.
Yeah.
Tony,
Yep.
on Thursday, could you talk a little bit about working with startups and them getting all of these systems established and what directors
Sure.
should and should not expect in the first year, for example? Yeah, can you talk a little bit about that on Thursday?
Sure, I can. So, I mean,
Great.
a perfect case example. One of the startups I worked with is a company called Syntep, which was developing a recycling shower. And we had grant funding. We won a competition called the Green Challenge, run by the Dutch Postcode Lottery, which gave us 500,000 euro to put into the development of the product. All that sort of stuff. We had all of the R&D tax incentive claims. We'd managed to get away without diluting equity. We sold off the majority of the business to a UK shower company. Then it all went pear-shaped. So, and then it's been going through the courts in the UK until last year when the founders finally got a positive settlement out of the whole thing. But yeah, it's a minefield, startups.
Yeah. All right.
So,
Thank you very much.
no worries.
See you
Okay.
Thursday.
See ya.
Thank you. Bye.
No worries.